Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the market so you can make actionable investment steps. I'm Jake Ackerman. Are we in a new bull market? Mixed bag of data. Is the Fed going to play nice next week, or are they going to strangle us? Let's take a look under the hood and see what is going on. So the S&P 500 has officially entered a bull market. Now, what does that mean? Since October of 2022, market bottom, and it's rallied 20+% since then. And that's the general definition that Wall Street uses to classify a bull market, and the vice versa. If the market declines from its high 20+%, it enters a bear market. Now, are these numbers that we need to stick by and say, hey, we're entering a new bull market. Oh my gosh, I got to jump on this train, the train that has already left the station. Does that necessarily want to do because of the announcement of a bull market? That's not a clear definition. And just because we've entered a bull market, again, doesn't mean that we're going to go and just keep going up from here. That is not the case. With asset prices, stocks, they do not go up or down in a straight line. All right. So take with the new reading and the new announcement that we're in a bull market with a grain of salt, and still be a prudent investor, because we have a lot going on right now. So let's take a look at last week's data, because we have a mixed bag of data right now that's going to dictate how our monetary policy is going forward. So last couple weeks ago, we had a hotter than expected PCE, which is inflation data. The Fed has pointed to this data metric each and every meeting. Expectation was 0.3, results 0.4. Next, we have jobs numbers. Jobs numbers came in much higher than expected, nearly double expectation. So the PCE, the hotter than expected jobs numbers, are inflationary pressures. Then we have something a little bit interesting taking place. The unemployment report ticked up, which is deflationary. Expectations were 3.5, we got 3.7. So the mixed bag of data, that just doesn't say, hey, the Fed is going to raise interest rates. Hey, the Fed is not going to raise interest rates. And, we've heard some Fed speakers come out and on press conference and say, some said, we're going to be data dependent. Some said, inflation's too high, we probably need to raise rates. And a few more said, I'm okay with pausing and letting to see how this monetary policy really plays out over the next couple months. With a mixed bag of data, what are they going to do? I think that Tuesday's data release, CPI, right before the Fed meeting, is going to give us that's going to give them the clear picture of what they're going to end up doing. That's going to dictate. So it's Tuesday the 13th, right before they meet at 8:30. That data is released. That's going to give them the path to say, hey, we've had hotter than expected CPI data. Let's raise interest rates. Or, hey, it's as expected or below. Hey, let's wait and see. So this is going to give them their ticket to make their decisions, since we've had a mixed bag of data. And the Fed officials all along this way have been saying, hey, markets, investors, we're going to be data dependent going forward. So that's their clear choice. That's their clear option once we get that release of the data. So let's tune in and find out what they say. So what's going on in the markets this last month? Markets in the last month has rallied nearly 5%. So if you've been in since October, we have a really not clear where the Fed is going to do next meeting because of this CPI report. I mean, honestly, I might rather see them just raise the interest rates one more time and get it over instead of pausing. Then the market's uncertain if they're going to raise rates in the next meeting or the following meeting. There's just like this feeling of uncertainty. Sometimes just ripping off the Band-Aid and getting it over with is the better option. But again, we have a political election next year. They don't want to tilt the scale one way or the other, and they also don't want to force us into a recession. And then that throws a whole different dynamic into a political election year. So, but But again, inflation's still too hot. I mean, you go to the grocery store. I mean, prices are still going up. You buy goods, they're still going up. There are a lot of deflationary pressures in the data as well, but they're all on these different timelines. So the Fed's really stuck between a rock and a hard place. They really are. So I would rather see them just do it and get it over with, but that might not be the course of action that take place because there's a lot of politics going on to it, right? There's a lot of unforeseen things besides the data that could be taking place. So I would think on Tuesday, right before the Fed meeting, that data point is going to drive their decision. So with that much uncertainty, the market rallying this much, sometimes it's really nice to ring the register. And if you're listening to the news and you're hearing new bull market, oh my gosh, I got to get in. Sometimes just sitting on your hands and doing absolutely nothing and being patient can save you big in the long run. A lot going on next week. The CPI, the Fed meeting announcement on Wednesday. Tune in on Friday. We're going to talk about it and discuss what that means for your investments. Jake Ackerman with Ackerman Financial, expertise you deserve, experience you can count on.